We'll be looking at harmonic patterns and, of course, few moving averages. We'll also look at a couple of other indicators while we are learning how to use harmonic pattern and using moving averages for entries, potential entries in the market, and of course, for potential exits as well when the market can go against us for many reasons. So, technical analysis, let's just get into what technical analysis is on the basic level. So most of you will understand that there is fundamental analysis and there is technical analysis. Fundamental analysis is basically to do with understanding a company or a product that you are investing in, the fundamental reasons for that particular product. Let's say, for example, if you're looking at Tesla as a stock, or let's take Apple as a stock for example's sake. If you are looking at investing in Apple, you would always look at investing. When it comes to investments, most of them look at a medium to longer term, let's say 2 to 5 years. Now, whenever you're looking at investing on a longer time frame, fundamental analysis is very crucial because you need to understand what the company does, what the products are, how innovative the company is, how innovative their products are, and what is the growth prospect of that particular company. How have they been doing for the last 5 years, or from the time they were listed, or from the time of inception, how profitable the company has been. Now you look through the financials, you look through a lot of research reports on how well Apple is doing and how well it could do in the next 2, 3, or 5 years. And that is where fundamental plays a crucial role. Yes, you can use technical analysis as well for taking an investment decision, but the use of technical analysis for investment or for a longer term investment decision is minimal compared to fundamental analysis. On the other side, let's say you're looking at trying to take advantage of a shorter term move, probably anything to do with 6 months or 3 months, 2 months, or probably sometimes in some cases also intraday. Now, let's take an example of you are a trader who is trying to take advantage of a momentum that has been created in the market for a short period of time, and you're trying to take advantage of that. Now, fundamental over here plays a smaller role, especially because you're trying to take advantage of a short-term move, especially if you're taking a decision to take a trade on on a daily entry intraday trade. You would not be bothered too much about the fundamentals. You would be more focused on looking at the momentum for the day. How many dollars can Apple move, or how much percentage can it move in your favor or against you? Now, Apple as a company fundamentally might be a very good company to be invested for the longer term, but when you're taking a decision on a shorter time frame, technical analysis takes the bigger role for you to make the decision. So, in short, technical analysis helps investors on a smaller range in terms of trading. Technical analysis plays a bigger role, and it'll help you understand which are good entry points. And technical analysis also has everything to deal with how the price pattern moves. So the movement of previous price patterns will give you an indication of what you could expect in the future. Let's look at a couple of examples as we go through. One of the main important tool that I'm going to be introducing today is a tool to understand average true range. Now, average true range is a technical indicator that is available on the platforms to understand how many dollars or how much percentage can a specific instrument move. Let's say, for example, if you're looking at Apple, you want to understand how many dollars can Apple move in a single day, or how much percentage can it move in a single day. ATR helps you identify that. And why is this important? And you can also look at ATR on a monthly time frame. Let's say you want to understand how many dollars can Apple move in a single month. So if you're looking at taking advantage of an entire month's move, it helps you identify how many dollars you can expect for the particular product to move, and then take a decision based on it. So I will give you a couple of examples for average true range when we get into the live session demonstration. Now, again, we have SPX over here. You go down to the technical tools and you select ATR. You can see over here we have ATR. You click on ATR and ATR comes at the bottom. Now, over here you can see SPX on a monthly time frame. Like I mentioned, that ATR will show you how many dollars it can move based on a given time frame. Over here, we are looking at SPX momentum on month. So you can see from all the way from 1998 till now. So on an average, SPX earlier on, it used to move in a range of $100. But at that point of time, we also need to keep in mind that the price of SPX was in a range of 1,000. So if it was moving about $100, it's actually giving a 10% move every month. Very important point to take note is when I'm talking about ATR, it does not give you a direction of which side SPX can move. It is only giving you an indication of how much SPX can move in a given month. So now, if you're on a negative month where the markets have dropped already by 110 points, you could always expect probably the downside for the month could be coming to an end based on the average movement. Yes, of course, there could be additional $20 move or an additional $15 move or $50 move. So $150 move back in the days, which would be about 15% move on $1,000 index. As of today, SPX is around 4,000 range, so it is moving about 350. So you can expect it to move again 8 to 10% at this point in time. Now, that is what ATR teaches us. Now, coming to the harmonics. Now, harmonic patterns basically appear in the trading charts. And to identify these harmonic patterns, we use Fibonacci, which is the foundations to identify harmonic patterns. So I will just go through the basis of how harmonic patterns are formed and how do you identify these patterns. Now, Fibonacci is a very common subject which everyone is familiar with. If you're not, it's not rocket science. It's very simple to understand. Fibonacci is basically a series of numbers. It starts with 0 and 1. If you add 1 plus 1, you get 2. You add 2 plus 3, you get 5. 3 plus 5, 8. 5 plus 8, 13. 8 plus 13, 21. 21 plus 34, 55. And it goes on to infinite. So now this is known as the Fibonacci numbers. So now, of course, if you look at any market movement, or if you're looking at gold commodity or a crude oil, or if you're looking at Apple, if you're looking at Tesla, they do not, go in these series. The movement on the charts are always in percentages. So hence, through Fibonacci numbers, we can derive the ratios out of it, which will give us a percentage for us to work with when we are looking at the markets. Now let's look at, okay, here's a fun fact. Fibonacci sequence also is known as golden ratio. It appears a lot in nature, patterns such as spirals of shells, sea heads, pine cones, branches of trees. All of these have the mathematical sequence when you actually pay attention to the design of a tree. I will give you a couple of examples. The things as large as galaxies, as small as a DNA molecule, follow the golden ratio rule. Okay, now if you remember, I mentioned to you that we cannot use the numbers directly on the charts, but we can use the ratio. And here, the golden ratio is 61.8. Now, let's look at how 61.8 also appears. Here are a couple of examples for where you can see Fibonacci numbers that appears in ratios. Here's a geometrical representation. You can see that you can make squares. 1 plus 1 gives you 2. 2 plus 3 makes the entire square for 5. 3 plus 5 makes the entire square for 8. 8 plus 13 makes the entire square for 21. And it goes on. And if you connect all of the corners of these boxes, you get a spiral over there. Now, these spirals is what we were looking at over here when we are talking about spiral of shells, sea head, pine cones, even flowers in certain cases. Now, on trees, most of the trees, the main trunk is the supporting factor for the tree. Then it splits into two, and then each of these trunks will have more branches, which again, when you count it out, we should have a Fibonacci number. If you have plants at home, probably you can check out how many leaves are there on each stem. Very easy way to see how Fibonacci appears there as well. This is Fibonacci in the spiral that you saw here. The same patterns appears within these. All of these spirals you see within the sunflower also has the golden ratio. Now we'll not get too much detail into this, but we'll see how this particular golden ratio actually helps us in trading. That is what we are here today for, to learn how we can use these mathematical sequence or the golden ratio in taking a investment decision. So I'll show you a couple of examples on that as well. This is our entire galaxy, and you can see the spiral appearing over here as well. And pretty much this also has the Fibonacci series in it. Now, coming to the most important thing, how do we use those numbers? We use it as ratios so that we get percentages out of it. And these percentages are what is used for us to measure how much a market can drop or how much has it dropped and where a market could potentially reverse from. Now, 61.8 specifically, the number is known as a golden ratio. Reason being, if you take any numbers from the series that we just saw here, let's say we take 2584 divided by 4181. So you take the first number, or you take any number and divide it by its following number, multiply it by 100, you should get 61.8. Let's just take 2 minutes. If you all want to quickly grab your mobile, take your calculator and do this, please go ahead and do this and post your answers on the chat. We'll just take about 30 seconds to do this exercise. So you can choose any of the numbers. You can take 10,946 divided by 17,711 into 100. You should be getting 61.8. Sorry, I think you all won't be able to see the numbers here. And you can also do it with bigger numbers. You can take 196, 418 divided by 317, 811, which will give you again 61.8. Think most of you all are getting it. All right. So the ratio and the golden ratio is basically any number you divide with the next number, you get 61.8. And hence the name golden ratio was given to 61.8. Now, pretty much 61.8 again appears a lot in nature. That I would let you all do your own research if you are more interested in how Fibonacci works in life and in nature and everything that we see. Let's go to the most important thing. Now, if we are looking at 61.8, which looks like a very important number, how do we apply this on the charts? Now, I assume that most of you, or in fact, majority of you all had said that you're intermediate. So I'm guessing you all understand how to read charts. But either ways, just to make it very simple and quick for beginners, we are looking at an Apple chart on a monthly time frame. That means each of these candles represents 1 month move. Okay, the candle has a body. The body actually shows the open and close price. If the open was lower and if it closed higher, you will see a green candle. If the open was higher and it closed lower, it will show a red candle. And the tail that you see on these are the highs and the lows that happened during the entire 1 month of each of these candlesticks. Right now, how do we use Fibonacci to measure? Now, Fibonacci ratio is used to measure. So I'll give you an example of how you can use Fibonacci for measurement. Let's say my height is 100%, for example. Now, if you measure my height, let's say I am standing at 100 centimeter tall. I'm not that short, but just for the example's sake, I am 100 centimeter tall, head to toe. Now, if you measure my entire 100%, and then if you see 60, 61.8% of that actually starts from my hip bone. So why I'm giving you this example is because as a human body, your upper body and your lower body is not 50% equally distributed. So there is a percentage that goes towards your lower body, and that is about 61.8%, and that helps you balance well. So it is a clearly a pivot point to help a human body function with all capacity. Similarly, I'll give you another example. You can measure your arm, where you take the length of your arm from your finger till your shoulder, and your elbow. If the length is 100%, your elbow should be at 61.8% of the entire 100% length. Again, if you notice that from your elbow till your fingers, uh, it's much more longer than your arm. Reason being, you have to lift weights and your elbow acts as a pivot point. Now, just keeping these analogy in your mind, let's look at every rally and every drop as either my height or length of an arm. So now, basically, this particular market started trending upward from this point here. It's very clearly seen. It goes up. It was kind of fading off here, did little bit of sideways movement and continued the rally. And after a certain point, it actually starts dropping, and you see the markets drop and then pick back up again from a certain point. Now, at what point did this pick up? Now, how do you use Fibonacci? Is you have your Fibonacci tool readily available in your draw tools and technical tools. So you can just measure this entire movement. So this entire move is 100% move here, and where does 61.8 of this entire 100% move come is somewhere here. You can see 61.8 here. In terms of price, it's around 22. So when the market started dropping is when you draw your Fibonacci to see at what point in time can it pivot, right? The crucial thing to keep in mind when you're using Fibonacci is at what point does it pivot. Since 61.8 is the crucial ratio in the Fibonacci series, you could expect the market to pivot from 61.8%. Another way to look at it is you came into the market, let's say in 2015, and the market has already rallied all the way from 2013 and 2014 you saw a big rally, and you are at 2015 now, and you just have a lot of money to invest, but you see that you have already missed out this opportunity. So you want to identify what would be an ideal time to re-enter the market. So now when you see the markets dropping after you are ready to invest, now you need to understand which is the ideal point to enter. Was it on this drop you would enter? If you had to enter on this drop, you would have still made a significant loss. Let's say you entered on this drop, you would have probably made some money over here, but eventually that went back down. So technically you would have made a loss again, and you would have had to wait for it to recover. Now, if you look at the time period between this drop and a recovery, let's assume someone bought at this price. They had to wait while it went down, and in fact you could have bought more at the lower end if you have enough funds. But let's say you didn't want to invest more, so you have not invested. You waited again for it to come back up to where you entered, which was somewhere around $30. So this is 33, you entered at 30. You waited for almost 1.5 years just for it to come back to 30. That means you lost out on this opportunity while waiting for Apple to recover. On the other side, if you have the technical knowledge, of course, we know Apple fundamentally it's a good stock to buy. But although it is a good stock to buy, it's always better to buy when it's at discount. So let's look at this particular rally where 100% move happened, and then when it came back down, it gave you a 50 to 61.8% discount. If somebody had to enter at 50% or 61.8%, then they would have pretty much captured at the entering at the bottom level. Now, is this always the ideal scenario? No. But is this one of the cases where you can use Fibonacci to have a double confirmation before you take any investment decision. Of course, you can always count on this because it has unbiased technical tool over here. Any other tool that you see in technicals are based on previous moving averages. So that means it takes the average of the previous closing prices or the open prices. So, and not every day the closing price is going to be the same. The closing prices can differ from day to day, from week to week, from month to month. So all the other technicals depend on the past data to give you an indication, whereas Fibonacci basically just measures a move that has happened and the move that has come to an end. Over here, the move began on the upward trend, and probably after waiting for a couple more months, you see the when the market started dropping. That's when you understand that this particular move has finished, and you measure this move. So you always measure a trend after you see a significant reversal in trend. Mostly when the trend reverses, it should ideally drop at least 30% to 50% to consider it as a trend reversal to measure. I'll give you a couple of examples on that as well. I hope everyone's clear. If you all have any doubts, please put your questions on our chat box over here. I'll be able to answer your questions. Now, let's look at what happened. So, this was 2015, and then 2016, we see the market started rallying. So, we see 2017, 2018, and let's go to the chart ahead. So now 2016 rallied, 2017 rallied, 2018 rallied, and at the end of 2018, we can see suddenly a sharp downward move. Now, of course, this happened in just 3 months. Downward moves are usually more faster compared to an upswing in the market. Nevertheless, we understood after it dropped about 50% that this particular trend has come to an end. And there you measure your trend again from the lowest point to the highest point, which is a 100% move from where the trend began to where the trend ended. Now, in this case, you see again it came to 61.8 and it jumped back up. Now, yes, this does look magical. So that means every time it comes to 61.8 and you invest, you will definitely make money. No, that is not what I'm saying. In this case, I have chosen Apple, which has shown a consistent pattern of 61.8 working for it. There are a couple of products. After you start doing technical analysis, you will identify that it not always comes down to 61.8. There are chances, most of the time it comes down to 88.6. So these are the other Fibonacci numbers which I did not mention to you. 50% is not a Fibonacci number. 50% is just there just to show where the 50% of the downward move is happening. 61.8 is the golden ratio. 38.2 basically comes for 61.8, you divided your first number with the second one. For 38.2, you divide your first number with the third number. And then if you divide the first number with the fourth number, you get 23.6. Now, 78.6 and 88.6 again are square root of 61.8. And that is how these the ratios has been formed and has been widely used and practiced by all technical analysts. Now, I will show you the advantage of 88.6 as well in my examples moving forward. So finally, let's just see after 2019, we see a rally happening again. So this is 2019, market rallied, and then you see again a huge drop here. So you measure this particular rally and you see it took support from 61.8 before it bounced back up. So, in short, 61.8 looks like one good indication to enter whenever you get a dip in the market. So, you can always use that as one of your measurement to add to your investment or trading making decisions. Now, let's look at harmonic patterns. So, how are harmonic patterns formed? Basically, using the Fibonacci ratios, we can find geometrical price patterns that appear on charts. Basically, harmonic patterns was founded by Gartley. So the first two patterns are named after him. So it is a bearish Gartley pattern or a bull Gartley pattern, depending on which direction the market is going to move. And of course, then later there were more patterns that came into existence while they closely observed Gartley's patterns and evolved from over there. Now let's look at one of the example. So according to Gartley, he was finally able to solve two of the biggest problems: what and when to buy or sell. So again, like 61.8 basically helped you make a decision when to buy. When the market starts dropping, you know when to enter. You don't want to enter too early, you don't want to enter too late. So 61.8 acts as a good base for you to actually start investing in Apple. Similarly, using these patterns, it helped Gartley to identify when to invest and when not to invest, when to buy and sell, meaning when to buy, when to exit. When it comes to even profit and loss, stop loss, the harmonics is going to help you. Now, let's see one example. We have a lot of harmonic patterns, but let's just stick to one just to understand how bullish Gartley pattern or a bearish Gartley pattern works. Now, if you do your research, you will see that every time you identify a Gartley pattern, and it completes all of these point range. Finally, the entry point is going to be at D, and the probability of this particular position going in your favor is very highly probable. So a lot of people wait patiently for all of these criteria to meet before entering their investment or trading decision. Of course, with this entry also comes a stop loss below the pattern beginning. So at whatever point in time, not all patterns are foolproof. It can always go against you, and you will have to make sure your risk management is always in place. Even if it made you profits with 100% hit ratio, it's always recommended that a risk management is in place in case it does go against you. Now, let's just look at this particular example. The black line represents the stock price moving. Now, from a given point, let's say from X, the stock rallies all the way to a certain point. Now, at this point of time, it could rally from any point to any point, so there is no measurement there. Once it reverses and it starts dropping, like what I explained to you earlier, that's when you identify that the uptrend has now come to an end. Now, let's say it went up and it came slightly down. That does not indicate the uptrend is over. It came slightly more down. That also does not indicate the uptrend is over. But let's say if it drops almost 40 to 50% of this entire upswing, that's when you can conclude that the uptrend for now has come to an end. So now once that happens, this is where you put your Fibonacci tool, you measure your bottom to the top, and then B point has to exactly come to 61.8. Now, if B at 61.8 market starts to bounce back up, now you have identified X, you have identified A, and you have identified B because it has taken support at 61.8. Now, vice versa, when the market went back up, it has to go back either between 38.2 to 88.6, again, which could be 61.8 here. So now you measure A to B from top to bottom to see if the price action reverses between 38.2 and 88.6. Most of the time it goes till 88.6 and then it drops. So now when it drops and when it completes at C and it starts dropping, this is where you start looking to make your trading or investment decision to enter at D. How do you identify the D point? Very simple. Again, you measure B to C. Now, in this case, C to D has to come lower than the entire rally here. So it's about 161.8 on the downside instead of 61.8, which would be halfway low down here. So once it clears at 161.8, this becomes your entry point, and below X will be your stop loss, and your take profit will always be 2 to 3 times your stop loss or above the point of A, because the market will tend to continue on the upside. Vice versa, if you are looking at taking a short position, whatever we applied here on the upside, we do the reverse of that. I will try and show a couple of examples as well. So in that you'll be able to learn how to draw the tool, identifying the patterns. You will have to have a lot of patience to see how to identify these patterns. You have to practice a lot. So practice makes it perfect. I would also recommend that if you were really interested to learn about this more, to always go and meet one of our client relations executive for them to sit with you and go through all of these teachings one on one for you to get equipped more. So now these are basically other patterns: bullish pattern, bullish bat, bearish bat. Now, if you see the criterias for these are slightly different. Now, when it drops, instead of dropping to 61.8, it has to drop to 38.2 or 50. And when it goes up again, it's 38.2 or 88.6. And on the lower end, instead of 161.8, it has to drop all the way to 261.8. And that's what makes it a bat pattern. I will not get more detail into the numbers. Let's stick to the basics. Crab again, it goes down much more lower than Gartley. Gartley was 161.8 here. Uh, Bat was 261.8 here when it drops. If you see Crab, it is 361.8 when it comes all the way till here, right? So these are the few criteria that differentiates pattern from each other. So that's about it when it comes to harmonic patterns. Now, do not worry about getting the harmonic pattern. The idea of identifying harmonic pattern in a single go. Let's look at implementing the Fibonacci on smaller time frame just to understand how to draw the Fibonacci's. And then once we understand how to draw the Fibonacci's, then we can always do get more into detail as identifying a pattern. Now, one last topic for the day before we move into the live charts is moving average. Now, moving average is very simple to understand. Like I mentioned to you, moving average is a technical tool. It is usually calculated to identify trend direction of a stock or a commodity, and it helps determine support and resistance levels. What is a support? Support is like, let's say, for example, Apple, when it was dropping, it took support at 61.8. Wherever the price tends to bounce back up from, that particular price always becomes the support area. And when it goes to a certain level, when it cannot break through that price, that resistance level is known as resistance. So traders use the terminology support and resistance to identify buying opportunities and selling opportunities. Now, most common time periods a lot of people use, it starts from 15 days, 20 days, 30 days, 50 days, 100 days, and 200 days. It depends on technical trader to technical trader, on instrument to instrument, and they can optimize it for them to get the best results. You can also you can also backtest if you had to use a particular trading strategy using any of these to see which one gives you the most profitable trades, and then implement that on your live trading session. Calculating moving average, all of us know how averages move. Let's say, for example, for the last 5 days, stock ABC closed at $23, 23.4, 23.2, 24, and 25.5. So basically, your simple moving average is calculated by adding up all the five. You divide it by 5 and you get 23.82 as the moving average for day 6. Now, 23.82 could act as a support when market comes back down. Let's say on day 5 the price was at 25.5, and on day 6 when it starts dropping and when it starts coming towards 23.82, now that is the average price. So technically at this particular average price a lot of people would consider buying, because if you see the stock price has been steadily growing. From 23 it went up to 24, and then it went up to 25.5, and now it has given a drop back to 23.82, which a lot of investor would consider getting back into the stock, especially if you're doing a short-term trade, to take advantage of probably next few days move, which could go to 26, 27. So that's just a very basic example. Now, moving averages, you can again go to your charts, go to your technicals. You can put your period if you're looking at 20-day moving average, 50-day moving average, or 100-day moving average. Now, in this case, we have taken a 20-day moving average. It's a simple moving average that we have looked at. And if you, I'm sorry, let me show this chart again. Yes, so this is the 20-day moving average. Now you can see this acts as support. So there are days where it comes, takes support on this and moves back up. And once it breaks below the support, it can also act as resistance. So every time it tries to go back up, it can act as resistance. So people can short the market here. And once it goes back up again, then you can look at buying. So this is just to have a simpler view of how you can use moving average. Of course, you cannot use one single moving average to make a decision. You always have a combination of tools that work well for you, and then use all those combination of tools to see if all of them are giving similar signals, so that your trade or investment decision becomes more valid when you look at couple of indicators together. Now, helps identify trends, which is true. You can identify a trend by just looking at a moving average. Of course, you don't need to look at a moving average to identify a trend, but it makes it more simpler for us to understand. A declining moving average tells you it's a downtrend. A rising moving average says it's an uptrend. Helps with trend confirmation as well. Yes, and we also look at a couple of crossover that happens between two moving averages. Now there are people who use a 200-day moving average versus a 50-day moving average. Now when you look at a 50-day moving average, you will see the 50-day moving average is quite fast moving with the price of the stock, compared to a 200-day moving average, because a 200-day moving average takes 200 days closing price as an average, compared to a 50-day moving average, because 50 days takes only last 50 days, so you see it move more faster. So whenever you see a faster or a smaller duration move above a longer duration moving average, it indicates that the uptrend has begun, and you can pretty much take advantage and ride the uptrend when a crossover happens. The most commonly used crossovers are golden cross and the death cross. Golden cross is basically what indicates a bull market, meaning going forward, when the crossover happens going forward, you can expect the market to be in a bull run or a bullish on an upward trend. A death cross on the other side, the name suggests it, that the market is in a bear market and you can expect the markets to continue dropping. And if you're a short seller, you can take advantage of a bear market as well. Both occur short-term moving average cross when short-term moving average crossing over a major long-term moving average, like I just mentioned earlier. And now in this case, we are looking at a short term moving below a long term. So you can see all these days it has been on the uptrend, and now it has the slow moving average has actually started crossing below the longer term moving average. So you can expect the markets to drop. Now, this you see again in a more um sorry, this is the same chart. I've zoomed it in more, and you can see how the crossover happens. And now this could be known as the death cross. Vice versa, if it had to happen the other way around, it would have been the golden cross. Bollinger Band, again, a simple moving average can help you identify a Bollinger Band. A Bollinger Band has an upper band and a lower band. So how a Bollinger Band works is, it for a, let's say for a 20 days SMA, simple moving average, it takes two standard deviation on the upside, two standard deviation on the downside from the moving average. Uh, just to have a visual of that, you will see the middle line is the 20-day moving average, and the upper band and the lower band is just two standard deviations from the middle line. Now, this also can act as support and resistance. So, for example, if you had bought based on the 20-day moving average, and when the prices move up, when it touches the upper band, you can actually book your profit and you come out of the position. and vice versa. You can actually take a reversal or a short position on the upper band, and when it comes back to the middle band, you can book your profit and exit it. So there are multiple ways that you can use our Bollinger Band too. All right. So any questions so far? I hope. Okay. Now, sorry, I can see the questions now. Yes, I will be able to share a couple of examples. In is the indicator for swing trade with 4 hour time frame. Yes, you can use most of these indicators on any time frame, but I will just explain to you how, when you're using your time frame, what to keep in mind, and why you're using a particular tool for that particular time frame. So let's just get onto the live chart, and let me just share my screen. Okay, I hope you all can see my screen. I'm just going to close everything. Close all. Okay. To be fair, I had taken Apple as my perfect example for 61.8. So that could be very, very biased. So I will let you choose an instrument. You can choose any instrument. You can use a stock, you can use an index, you can use a commodity. Let's choose your choice of instrument and let's put Fibonacci to it. So is there any instruments that you all want to use? Please write it in the chat. Any product. So we have pretty much every product under the sun. So you can choose any product from this and let's apply Fibonacci to it and see what Fibonacci has to tell us. And also let's do the same on the same instrument for different time frames. Any suggestions? SPX, gold. Okay, perfect. Let's look at SPX. We'll look at gold as well. I've opened SPX. Perfect. Now let's start from a higher time frame. Okay. Now let's look at. I'm going to change my candlestick to Haiknashi. Reason being, Haiknashi gives you helps you identify trends more clearly. So in these cases, that you can see trends more clearly using a Fibonacci. I mean to apply your Fibonacci. Let's just look at the recent rally that has happened. So now you see rally pretty much began from here, or an uptrend basically got confirmed once this green candle formed, and we go up all the way till the highest point. In this case, yes, it has come back down to 61.8 and it has dropped. However, there are people who would argue that the uptrend actually began from this point onwards, which is also very fair. Ideally, you can start all the way from the bottom. I would prefer to always look at when the actual bulls took control, but both are correct. You can use it uh, the way you would want to. I would always prefer to choose the lowest point to the highest point. Now, in this case, you see market started crashing. Now, one point that I need to make it clear is when you're doing technical analysis, you discount all fundamental analysis. Meaning, fundamentally, there might be a lot of things that can be going wrong when the market is dropping, right? So, if that is the case, we would not pay attention to when to enter the market, fearing that we might enter into a recession, fearing that it could enter into a more downward trend. But if you're looking at Fibonacci purely and you're doing a trade based purely on technicals, you just follow the rules of technicals. Now, when market comes down, in this case, it did not come down to 61.8, hence we would not have taken a trade. But there are people once who get accustomed to using Fibonacci, they would have probably entered a little bit here. Let's say you wanted to invest $10,000 in SPX. So you invest $2,000 at 23.6. You invest another $3,000 at 38.2. Probably you would invest another $3,000 at 50, and then you would probably keep another 3,000 to enter at 61.8, or maybe even a $5,000 because you're getting at a much better price. Now, this is on the longer time frame. Now, let's go to an extremely smaller time frame. Let's go to a 30-minute time frame and look at how the swings have been. And we'll just measure all the swings that has happened at least from 21st till now. Let's look at starting from 21st. So we see a small swing that happened here. Oops, I'm sorry. 21st, yes. So I'll just zoom this in. So we had a swing that took place here. Okay. And after this swing, the market starts dropping. It came to 61.8, ideally an entry point. Now, since you're looking at a 30-minute time frame, you're looking to exit maximum in the next 4 hours or within the day. So that is what a 30-minute time frame would allow you to do. You can't take a trade here and wait for 1 month for you to make a return. It's always an intraday trade, especially when you're looking at 30 minutes. Now, like I mentioned, whatever happens, we always keep a stop loss below the point A or the point of starting of the Fibonacci. So in this case, you entered at 61.8, market continues to drop, you exit with a loss and you're out of this trade and that gave you a loss. Now this is your second trade that happens. In this case, market rallied, but it never came to 61.8, so you would not have bought it. Market continues to drop, and then you see another significant rally that took place at this point here. Okay, now this happened today. Sorry, this happened on the 23rd. Now market rallies and then it starts dropping. Like I said, you cannot assume it's a reversal trend with just one candlestick. You wait for the markets to at least drop 50% of this entire length. So once it drops below 38 to 50%, you understood that it's a downtrend and you look to enter at 61.8 here and you keep your stop loss below this. In this case, market took support at 61.8, bounced right back up. After that, we will see there are a few more rallies here. I'm just looking at the upward swing. I'm not looking for short selling. I'm just looking at buying. So every time market makes a swing upward and it gives a downward swing is an opportunity to buy. Here is a 61.8 to buy. Let me make the font size a little bigger so everyone can see the numbers. Sorry, yes. So here you see again, it came down to 61.8. In this particular rally that happened here, it did come to 61.8, but however, it went below the 100%. In this case, it would have hit your stop loss. If you had kept your stop loss a little far away, you would have gotten lucky with that. But the idea is you keep your stop loss right below this so that your losses do not increase more than what we anticipate. Now, this is on SPX. Let's just look at an example on gold. Perfect. So we have gold. We are looking at daily. Let me look at a shorter time frame. Maybe let's take 30 minutes for this. So gold has been on an uptrend. It has not given a downtrend here, so technically nothing to see there. But of course, on the smaller swings here, there would have been a couple of opportunities. Let's look at a weekly chart, changing it to Hakanashi to see the trends. Let's just do a monthly chart and go from there. So in the monthly chart, we see there was a big swing here in 2005. Let me zoom that in. So in 2005, there was a big swing upward and then it made a downward trend. It came to 61.8, bounced right back from it. So that would have been a good ideal point for any investor because we are looking at a monthly time frame. Now, keeping in mind when you do make a investment decision on monthly time frame, you're always looking at minimum 6 to 12 months, but some of them could go to even 2 to 3 years. So we see another drop that happened here. So this was a very big swing that happened all the way from 2008 till 2010, where it kind of peaked out and it started dropping in 2012 and it came to a certain point and went sideways for a couple of years and actually went back up higher again. Again, if you notice, this is at 61.8. So we see 61.8 working in gold as well. Now, in the shorter period, we have this last swing that has happened. In this particular swing, it went up, it came down till 50%, and it is still hovering in this particular region. If you're looking at investment on gold, I would recommend wait for it to come down to 61.8. I'm talking about investment as like 2 to 3 years, 5 years scenario. But again, gold on the other side, investment wise, it does not yield you much because look at this particular example here. Uh, Whoever held on to gold or bought gold at these levels, the market actually dropped. It started dropping in 2012. It stayed lower in 2013, 14, 15, 16, 17, 18, 19 before it gave a rally. So basically between 2013 to 2019, 6 years, gold did not do much at all. Unless you were trading on gold, yes. But if you looked at it as investment, basically in the same time frame, if you look at SPX 2013 to 2019, or even Nasdaq in that case. Sorry, let's look at monthly. So 2013. So this is 2013 and this is 2019, right? So if you are to invest the same money in from 2013 to 2019, you would have technically made 117% return on SPX, whereas gold, technically whoever bought at the high would have been making a loss initially, okay, of 38% loss. But let's say they did not buy it over there, they bought it at a lower price, they still waited till 2019 and would have made only 47%, provided that they had bought it at the lowest point. But let's say on an average, if somebody had to buy over here, technically after waiting for so many years, they would have maybe made 10%, which is not that attractive. Yes, if they did hold on to it, in 2020, they would have made 41%. Let's look at SPX. If the same investment in 2021 would have made 160%, in 2020, yeah, this is 2021, sorry. So till 2021, it would have actually given them a 200% return on their investments. Now I'm talking to all the ones who are looking at a long-term investment horizon. People who are looking at trading, it really does not matter for them on the long term. It will always matter to them on every swing. For example, if you're looking at 30-minute chart, you look at your 30-minute time frame for the charts to take advantage of these small swings, right? So this is with your Fibonacci. Now, since we are running short of time, I just have another 5-10 minutes. I will show you how to utilize your Fibonacci and ATR. Remember ATR that I had mentioned to you, which is very important to understand. Let's take gold itself as an example. You're looking at, let's say, on a 4-hour time frame. Now we understand that gold has rallied quite a bit. So you go to ATR, sorry, technical stuff. All right, perfect. Now, what gold ATR chart is telling me is, let's start with daily. In a single day, gold can move on an average of $23. So if you are a short-term trader and you're making $8 as profit for the day, I would recommend that is a very good one because you pretty much captured 50% of the average movement of gold. If you are a short-term trader and you're actually making $15 of profit a day, when I say $15, I mean the movement into your number of units, then you're actually capturing almost 70% of the move for the day. So it's a very good time to exit. So ATR helps you to understand when to enter and exit even without using any other technical tools. Now, let's say this is on a daily chart. Let's say you're taking a trade on a 30-minute chart. Now, on a 30-minute chart, you can expect gold to move maximum $4 to $5, and that is what you see over here. On an average, it's actually $3, but as of now, for the last 1.5 hours, you can see gold average movement has gone up to $4. Now, looking at the higher end, there is resistance here, but let's just look at using Fibonacci on this from the lowest point to the highest point. This was a low point here. This is the high point here. It's not a perfect trend, but nevertheless, it has caught up quite high over here and then gives a sharp drop. So this trend, if you look at it on a R chart, you will be able to identify maybe on a 4-hour chart as a proper trend here, right? So you see the market trended upward and then it drops, let's say in this case to 61.8, going back to 30 minutes. Now, how do you use ATR to again decide your stop loss and take profit? Let's say if you entered at 61.8, trade from chart, limit order. So I'm just assuming that we had put a limit order, we bought it at 61.8, which is at 1966. Let's say you buy 10 ounces. 10 ounces is investment value of almost $20,000. Now we need to identify how many dollars can you expect to keep as stop loss and take profit. Now, stop loss two ways. You can keep it below the pattern or below the Fibonacci measurement where it started, and you can keep a take profit of $4 to $5 higher. Now, you bought it at 1966. You can expect the price of uh, gold to go up by $4 to $5 based on your ATR. Now you can always double up because you're on the uptrend, so you can always keep a $10 take profit. So you entered at 66, you can keep a take profit at 76, and you keep a stop loss probably also at $5. If you're not using the rule of Fibonacci, then you use the rule of your gold, meaning after you entered, if it goes against you by $5, you exit because you're looking at every 30 minutes. But in the next 30 minutes, it goes back up by $5 to $10. You actually book your profit and you exit from that position. So when you're looking at take profit, you look at $10 move in your favor based on ATR, double it. Your stop loss has to be maximum as close possible to the ATR. But if you're okay with a little higher risk, you can always keep 1:1. Then your risk reward always becomes 1:1. And your take profit and stop loss is set purely by using ATR. So now let's look at probably a bigger time frame on a 4 hour, no, sorry, let's look at it on a weekly chart. Now, weekly, we can see over here that prices have been giving a good range. This was a good upward swing, it came down. We see another upward swing over here, and this was a potential entry point. So you would have entered here when it went back up. Most likely, it would not have triggered your take profit, but nevertheless your entry point was good, and until and unless it broke below this. However, because you have entered here and you have kept your stop loss, you're still in the market making money. So that is what the discipline helps for you to become a successful trader. So if you're using Fibonacci, if you're using ATR, if you're using SME, what the main criteria for you to succeed and become a profitable trader is to always keep your risk management in place, to always make sure all your trades that you take, you verify it with one or two indicators before entering. And if you're entering, let's say, purely on Fibonacci, and you have entered at 61.8, you make sure you keep your stop loss below this. So you have already counted. Let's just take this as an example. Uh, Limit order at 61.8. This is the price that we would have entered. Let's say an investment of $10,000. Market actually started dropping. Your stop loss is here because your take profit will be on the higher end. Now, in this case, what would have happened is when you are taking this trade, you have already determined your stop loss. You have already determined your take profit. Now, if you feel that $1,100 is not worth for this particular trade, you can always reduce it to five units. Now, instead of losing $1,000, if when it goes against you, you lose only $500. But every trade that you take should have a consistent amount when you make your profit and loss. Most of the time, it is always best to have 1:2 risk reward ratio. That means if you're willing to risk $500, you should also be looking to make at least minimum $1,000 on the upside. If that trade is not going to give you a double of how much you have risked, then you might as well wait for the next opportunity on a different instrument for you to come out profitable. So even if you have less number of trades that hit take profit, you would still be at a much better place than keeping a stop loss wide and keeping a take profit closer. On a smaller take profit, yes, we would have made $400, but if this went against us, we would have lost $1,200. That means I need to do another four trades for me to recover the loss before I come back into profit. So just to summarize today, I'm sorry I was not able to go much more detail into the harmonics because we are running short on time. But however, if you like the session and you want to get into it more, we are always available. You can book a session with us and come sit with us for one-on-one, and then we can continue these sessions for you on one-on-one basis as well. So I thank you all for spending time with me listening to the trading presentation today. I hope it was helpful for you as well. Please do give me your feedback. If you have any recommendations, please do write that in the chat. I would be happy to take your feedback and recommendation. Thank you again for joining and hope to see you all in the next session or in our office sometime soon. Take care and have a good day. Thank you.